Thank you so much, JP. Thank you so much, everyone, for joining me this afternoon. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today, what I want to do is continue what Ed just spent quite a fantastic event talking about the mechanics of buying and selling options and option contracts. What I want to do now is take it one step further. And I want to talk through the 4 core strategies: buying a call, buying a put, selling a call, and selling a put. And I want to talk through when you should use each one of these strategies, because for those of you that are in the learning process of how to trade options, you must first understand these 4 fundamental building blocks before you can even move on to understanding when you should utilize them. So today we're going to dive into some examples. I'm going to first talk about it from a theoretical perspective. Then we're going to look at some real examples to show you the difference between buying versus selling options. And what you're going to be able to utilize this knowledge for is as you get into some of the basic strategies, such as selling covered calls, buying calls or puts to speculate, or selling puts to try to acquire stock. You're going to want to know why you want to use different strategies for different cases. But also, more importantly, when you get into more advanced strategies, when we talk about debit spreads, credit spreads, complex strategies, without first understanding the fundamental building blocks, the more complex strategies become very, very difficult to understand. So today, what we want to do is break down the fundamentals, understand that first, and then the rest of options trading will be a lot easier to understand. So let's go ahead and get started. But before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to start off by talking a little bit about stocks versus options. I saw some questions prior about whether, some questions in the Q&A windows as to what's the difference between buying stocks versus options. I'm going to break down that so that you have a better understanding. We're going to talk about the 4 basic strategies. As I said, Ed already gave you a pretty good preview as to what the 4 basic strategies mean, but we're going to take a little bit more of a practical approach as far as some real examples of taking a look at bullish strategies, which is buying calls and selling puts. And I'm going to show you what are the differences between buying calls and selling puts, and how do you actually decide which bullish strategy do you want to deploy from your portfolio. Then we're going to talk about the 2 bearish strategies, which is buying puts and selling calls, and talk about when you want to buy puts versus sell calls when you have a bearish view. And then we're going to go through as many examples as possible, but at the very end, I do want to do a quick brief introduction to option Greeks. Now, this is typically a more advanced topic, but I think it's relevant to what we're going to talk about here today. At the very end, we'll have a few minutes for Q&A so that you guys can ask questions about everything I go over here today. Now, but the primary answer that I want everyone to be able to walk away from here today is understanding what is the fundamental difference between buying and selling options. And this will also help you answer the question as you get further down the line with your education as to, should you trade a debit spread or a credit spread? Should you trade an iron condor or any other strategy? It is all based on the fundamental understanding of buying versus selling options, because all advanced strategies are built from these 4 fundamental building blocks. So that's why I think it's so important that everyone, regardless of whether you're brand new to options trading or if you're an experienced options traders, to make sure that you understand this topic through and through. So before I get started, please bring up your chat window, which is at the bottom of your screen. And please type yes if you're learning how to trade options, you're brand new to trading options. And please type no if you have some experience trading options or you're an experienced options trader already. So yes, if you're brand new, no if you are an experienced options trader. Okay, so I see a lot of yeses. So I think this is the perfect topic for those of you that are still in the learning process, because this is going to break down and give you a better fundamental understanding. For those of you that answered no, this will be a very good refresher, because as you get into more advanced topics, many times I get a lot of questions from traders, should I buy a call? Should I sell a put? Should I trade a debit spread or a credit spread? This is all based on these fundamentals. So let's first talk about stock trading. And the reason we need to talk about stock trading is because we want to understand what exposure do we actually get when we're trading stocks. You have 2 choices when you buy a stock. When you trade stocks, you can either buy the stock or you can short the stock. And the thing about this type of strategy is that it's purely what we consider bullish or bearish exposure. What does pure bullish or bearish exposure mean? It means that you get immediate gains if the direction that you called is correct. So if you buy a stock and the stock goes up by even a penny, you start making money. On the flip side, if it goes down by a penny, you start losing money. The amount of exposure that you have is purely symmetrical. So if the stock goes up by $10, you make $10. If it goes down by $10, you lose $10. There's a symmetrical exposure, but however, there's no time exposure. Meaning if a stock goes up $10 in a day or a week or a year, it doesn't matter how long it takes for the stock to go up that $10, you make the same amount of profits. And when you trade stocks, there are no neutral options, meaning if the stock just moves sideways, there's no way to profit from that stock position. So I think everyone here is probably familiar with stock trading. If you've traded stocks before, please type 1 into the chat window, because I think this is something that we all understand, right? Symmetrical exposure, you immediately get gains if you're right, you immediately have losses if you're wrong. That is easy to understand. Now let's talk about option strategies. So as Ed said before, you have 4 strategies. You can buy this call, you can buy the put, you can sell the call, and you can sell the put. Now, Ed talked to you through what these mean, but for those of you that are in trading, you want to know when should you utilize this. And this is really where buying a call option is typically considered a bullish strategy. Buying a put option is considered a bearish strategy. Selling a call is considered bearish, and buying a call is bullish. And I have some really neat ways to help you remember, for those of you that are brand new, is that buying and calls are positive, selling and puts are negatives. And all you have to do is basic multiplication between the two to remember whether you're trading a bullish or bearish strategy. But when I said bullish or bearish strategy, I'm referring to stocks. When you're looking at these option strategies, it's not fair to say buying a call is bullish and selling a put is bullish. And I want to break down to you and help you understand why. Because if you just call buying a call bullish and buying a put bullish, then you're really missing some of the nuances of options trading. So today we're going to break this down for you. So let's say I have stock XYZ, it's trading at $100, and I think this stock's going to go higher, right? So as a stock investor, you might buy the stock and hope that this stock goes higher. But as an options investor, we're going to go through the first example, which is buying a call option. This is the simplest option strategy to learn as a beginner, buying a call option. Now, let's say I buy a $100 call option, and let's say this call option currently is trading for $4. So as Ed showed you before, each option contract is for 100 shares. So to buy a call option for $4 means that you're risking $400, or you're paying $400 to buy that call option. And that controls a $100 stock with just $400. So a $100 stock to trade 100 shares of it, that's $10,000. Here, you're controlling that for just $400. And what do you get when you buy a call option? You get unlimited gains to the upside. So if the stock does go higher as you expect it to, you get gains to the upside, and the limit as far as how much money you can make is unlimited, just like a stock. If you buy a stock and the stock keeps going higher and higher and higher, you make more and more money. On the flip side, when you buy a call option, there's a limit as to how much money you can lose, because no matter what happens, as Ed was showing you before, the most you can lose when you buy a call option is just the $400 you pay. Unlike when you buy a stock, if the stock keeps going lower and lower and lower, you lose more and more money. So this asymmetrical risk, where you get unlimited gains if you're right, with limited losses if you're wrong, is what attracts many investors to options trading at first. But it's not exactly clear for most investors as to what you're actually giving up when you get this asymmetrical risk, because why would anyone want to take on unlimited downside with limited upside? So this is really where what we want to do is explain the difference between buying a stock versus buying a call option. So we talked about the benefits: unlimited upside with limited downside. That sounds great to everyone, right? But the truth is that when you buy a call option, because you have to pay in order to get into that contract, this is a strategy that it's technically bullish, but we call it bullish by a certain amount, meaning I can't just believe the stock is going to go higher for me to buy a call option, because my break-even price is actually higher than $100. So not only do I have to believe XYZ is going to go higher, I have to look at how much does the call option cost, what is my break-even price as a result of that call option, and I have to ask myself, do I think the stock's going to exceed that break-even price. So in this particular case, because the call option costs $4, my break-even price is 104. So basically at expiration, I have to not only believe that stock is XYZ is going to be higher, I have to believe it's going to be higher than $104. That means I think it has to be at 105, 106, 107, 108, 109, 110 or higher. And that's not something that you always find yourself in the position of, because sometimes you might say to yourself, well, I think this stock's going to go up to 103. Well, guess what? If the stock goes up to 103, you got the direction correct, but guess what? You would have lost money on the trade. And this is the most counterintuitive part about options trading for most beginners, is that you buy a call option, you think that you're going to make money because the stock goes higher, the stock does go higher, and then you end up losing money. If anyone can relate to that, please type 2 into the chat window. If you've ever bought a call option, the stock went higher, and then you ended up losing money on the trade. That's disheartening, right? And that's why I want to make sure everyone understands this before you get into a trade. That's the trade-off that you're making, right? Everyone wants this hockey stick. Everyone wants to have unlimited gains to the upside with limited losses to the downside. That sounds great, right? No one wants to be able to have unlimited losses to the downside. But what you're trading off here is the fact that you have to overcome the break-even price. What is the break-even price determined by? It's determined by the cost of the call option. That's why when I say long calls are bullish by a certain amount, it depends on how much the call option costs. So the next time you think about buying a call option, you can't just say that I think the stock's going to go higher. You have to ask yourself, how much does the call option cost? How much is my break-even price? And do I think the stock's going to exceed that break-even price? If you think it's going to exceed that break-even price, then it might be worthwhile looking at buying that call option. If you don't think it's going to exceed that break-even price, this is probably not a trade you want to make. Does that make sense to everyone? Please type 3 into the chat window if that makes sense to you. Hardest lesson to learn in terms of options trading, in my opinion, is getting the direction right and still losing money on the trade. And it all comes down to this. So remember, call options are not just bullish, it's bullish by a certain amount, and that amount is driven by the cost of that call option. So next, let's talk about the second bullish strategy, which is selling puts, right? Selling puts is same thing. It's a bullish strategy, but I call it somewhat bullish, but not by too much. And I'll explain why. So same thing, I have stock XYZ. I think the stock's going to go higher. So let's say I sell a $100 put option, and let's say I collect $4 credit for this. So when you sell a put option, or when you sell any option, you get paid the premium. When I bought the option, I have to pay that option premium. So when you get paid, what happens is, now when you sell a put option, what happens is that if the stock stays above $100, your strike price, you basically keep the $4 credit that you receive. So this is one of the more neutral strategies. So if the stock stays exactly where it is, meaning if the stock doesn't move, it just stays at $100, you make $4. If it goes up above $100, you make $4. No matter how high the stock goes, the most you can make is $4 a share. Now, the risk that you take with the type of strategy is that you have technically unlimited downside. So if the stock keeps going lower and lower and lower, so I thought the stock was going to go higher, right? But what if I'm wrong and the stock goes lower? When you sell a put option, the further it goes lower, the more money you lose. So you have unlimited downside here in exchange for just the $4 premium. And many investors will say, that doesn't sound like a risk profile that sounds good to me, right? If I get the direction right, I'm only going to make $4. If I get it wrong, I could really expose myself to a lot of losses. And the reality of it is that, yes, technically the downside is unlimited, but when we show you some examples, that might change your views onto this particular strategy, because what happens is this $4 that you got provides you with a buffer. So you think the stock's going to go higher, right? So if it goes higher, you make your $4. But what if the stock doesn't go higher? If it stays at $100, guess what? You still make $4. Even if the stock goes a little bit lower, let's say the stock goes in the opposite direction that you expected to, guess what? You can still make a profit. Only if the stock goes significantly lower do you start losing money on this particular trade. And that's attractive to certain participants of the market, because you might think the stock's going to stay in this particular range, and you're okay with taking on, in the event that something makes a big move to the downside, that you do have some losses. But if the stock stays where it is, goes in the direction you expect it to, or even goes against you, you can make some money. And that's the trade-off that you make for this unlimited loss down to the downside, is that you can get the direction right, make some money, you can get the direction kind of neutral, still make money, and you even get the direction wrong and still make some money. It's a very forgiving strategy, okay? So whenever we talk about options, we're always talking about trade-offs here, and that's the trade-off that we're making when we're selling options. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Okay, now what I'm going to do is I'm going to go through a quick example to show you the, sorry here, I got logged out, 1 second. I want to show you a real example because I think the best way to learn is to learn with a real example here. I'm going to use Barrick Gold here for 1 second, okay? And I'm going to show you the difference between buying versus selling a put option. So Barrick Gold is trading at 39.24 right now. So what I'm going to do is I'm going to use the 40 strike option. Now, I don't have quite enough time to walk you through the whole platform here today, but I do want to show you the power of the OptionsPlay platform. And I'll show you how to access this using at the very end, how to access this same tool. It's free of charge to everyone. So let's take a look. Barrick Gold is at $39. What I'm going to compare is buying an October $40 call, an at-the-money call option, and I'm going to compare it to selling an October $40 put. So the same strike call versus put. If I buy the call option, it costs me $1.90. If I sell the put option, I collect $2.60. Now, my break-even price on this call option here is $41.90. So I have to believe Barrick Gold will be above $41.90 by the expiration date in order for it to make sense for me to buy that call option. So the next time you think about buying a call option, you have to ask yourself, do I think the stock's going to exceed that break-even price? Because if it does, then it makes sense for me to buy that call option. But if it doesn't, it does not. Same thing here. When I sell a put option, because I sold that put option, I collected $2.61. My break-even price is $37.39. As long as the stock stays above $37.39, if it goes higher, if it goes sideways, or even if it moves a little bit lower, I'll be profitable in all of those scenarios. So let's use our P&L simulator and actually let's take a look, right? Barrick Gold is currently at $39.24. Now let's say on October 16th, on the expiration date, the stock stays exactly where it is. It didn't move any higher, it didn't move any lower. The P&L simulator allows us to actually understand each strategy and see how they're performing. So here, if I bought the call option, I would lose the $190 that I paid because that's the trade-off that I make when I buy a call option. If the stock doesn't move, I lose money. On the selling the put option, I make some profits here. Now, if the stock goes lower, meaning if I get the direction wrong, guess what? When I buy a call option, my risk is limited. But when I buy a put option, my risk is unlimited. But notice how far the stock needs to go before the put option starts to exceed in terms of losses to the downside. The stock has to get down to about $35 or so, all the way down here. It has to get below 35 in order for the short put to start having larger losses than the long call. So as you can see, you're making different trade-offs here. And on the flip side, if I do get the trade right, notice how far the stock needs to go before the call option starts to exceed the short put. The stock has to get above 44.5. So even though my break-even price is $41.90, this stock needs to get above 44.5 before the call option starts to exceed the put option. So I get unlimited gains to the upside, right? But notice how that unlimited upside doesn't really only kicks in after a pretty large move here to the upside. So that's why selling the put option is, for many investors, the preferable trade, but it really depends on your market outlook. Because if you think it's going to make a big move, you want to buy that call option. If you think it's going to be more neutral, you might want to sell that put option. Now, I don't advocate that everyone goes out there and sells puts. This is, again, more of a learning process so that you have a better understanding of these strategies. Because as you get into more advanced strategies, you're going to understand how this is relevant for that trading. But does that make sense, everyone? Please type 5 into the chat window if those two comparisons between buying that call and selling that put option make sense. And I'll show you how to access this tool yourself so that you can actually learn and do the analysis yourself. So now let's take a look at buying put options. Now, once you understand buying call options, buying put options are fairly simple because it's just a mirror image of it. So instead of being bullish on stock XYZ, let's say I'm bearish on stock XYZ. I think it's going to go lower. So what can I do? I can buy a put option. Let's say I buy a $100 put option and it cost me $4 to buy that put option. So once again, just to clarify, even though technically buying a put option is bearish, I don't think that's an accurate explanation. The correct way to understand puts is that it's bearish by a certain amount. That certain amount is driven by the cost of the put. Sometimes this put option costs $4. Other times this put option might cost $6 or $8. So the more costly the puts are, the lower your break-even price, meaning the bigger the stock needs to move in order for it to make sense for you to buy that put option. So when we talk about a put option, what happens is that you get unlimited gains to the downside all the way down to zero. In exchange, you have limited losses. If you're wrong and the stock goes higher, you can only lose the $4 a share. Even if the stock jumps from $100 to $200, you're only risking $4 a share. The only trade-off that you're making with this asymmetrical risk is that you need the stock to move a fair amount before you're profitable. So you have to believe the stock's going to go down to 95, 94, 93 or lower before this makes any sense, before it makes sense to buy that put option. The more expensive the put option is, the bigger the move. The cheaper the put option is, the smaller the move it requires for you to be profitable. And that's why whenever we talk about, and this is true for any asset, right? When you buy, you want to buy low and sell high. So when you're buying puts or buying calls, you generally want to buy puts or calls that are relatively cheap because the cheaper the calls or the puts are, the more potential that you have for making money on that trade. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. Like I said, this is just a mirror image of the calls. So now let's take a look at selling call options. This is a same example. I think the stock's going to go lower, but instead what I have here is that if I sold a call option here, if I sold a $100 call option, and let's say because I sold it, I collect the credit as opposed to paying for it, instead of requiring the stock to make a big move in order for me to profit, what I want to do is I want the stock to stay neutral because what I collect is the buffer that I get. The larger the credit that I receive, the larger the buffer that I have. So when I sell a call option, I make money if the stock goes in the direction that I expect it to. I make money if the stock doesn't move at all. And I can even make a little bit of money if the stock goes in the direction against me. I only lose money if it takes a big move against me. And the bigger the credit that I receive, the larger the move that the stock needs to make before I lose capital. So as a seller of an option, whether you're selling a call or a put, what you want to do is you want to sell calls or puts that are expensive because that gives you the largest possible buffer. Does that make sense, everyone? Please type 7 into the chat window if that makes sense to you. Okay, so let's take a look at just one more example. Let's look at Sucor Energy. This is an energy stock really falling through some major support levels. So maybe you're bearish on this trade. So what I want to do is I want to look at buying an October $18 put option versus selling, let's say, an October $18 put option. So here it cost me 93 cents or $93 to buy an $18 put. I collect $1.08 on an $18 call option. Using the P&L simulator, what that allows me to do is simulate what happens if the stock stays where it is. As you can see here, I make an $89 profit versus losing $93 if I bought the put option. So if you think the stock's going to stay neutral, you certainly don't want to buy that put. The put option only really comes into play, as you can see, and you can use this P&L simulator to see, only if the stock's below $16. The stock's at 18. So for it to go down to 16, that's almost about a 10%, a little over 10% move to the downside before the put option starts to outperform selling that call option. As you can see, if the stock keeps going lower and lower and lower, I'll make more and more money on that put option. But if the stock makes a modest move to the downside, I'm better off selling that call option. If the stock starts to go against me, notice how I still have a buffer. So because I collected that $1.08 on this short call, even if the stock goes against me, I have a bit of a buffer here. I have exactly $1.08 buffer because my break-even price is 19.08. As long as the stock stays up below 19.08, I can be profitable on this trade. So as you can see here, even though the trade starts to have losses if the stock makes a big move, the loss is still smaller than what I paid for that call option. Only if I get a big move to the downside does this start to exceed. As you can see, the stock has to be above $20. So back into the trading range, back above this support level. Only when that happens does the short call start to exceed in terms of losses. And the further it goes, the more money I lose. So that's the trade-off that you're making whenever you're selling options, because selling options is a very forgiving strategy. You can make money in all different types of scenarios, but the trade-off is that if the trade makes a big move against you, that's when you start to have some big losses. So options are always a trade-off. One is not better than the other. I get a lot of questions from people saying, should I buy a put or should I sell a call? The answer is it depends on what your view is on the markets. What I'm here to do is instruct you and help you understand the difference between the strategies so that you can decide for yourself which strategy is best suited for you. So with that, what I do want to do is spend just a couple of minutes on the option Greeks, because what I've just shown you so far is showing you what the option will be worth at expiration. But many times when you buy, let's say that October put option, maybe the stock makes a big move to the downside over the next week, and you want to understand how much money do I make if the stock makes a big move down in the next week? So that's where we turn to the option Greeks. So every option that you trade has these metrics on them called the Greeks. Now, you don't have to actually do the calculations because the P&L simulated that I just showed you does that calculation for you. But it's important that you understand how in the background all of that works. So for every option that you purchase or sell, that option has a Greek called delta. And what delta tells you is how much will the change in the option price versus a change in the stock price. Meaning if the stock goes up or down, how much does that affect the value of the call or put that you own or purchased? So if you have a call option or any option that has a delta of 0.5, what that means is that if the stock goes up or down by $1, the option will increase or decrease by half as much, or 50 cents. So if you have let's say you bought a 2-month $100 call option, and let's say you paid $5 for that call option. So you bought a 2-month call option, you think the stock's gonna go higher, and you paid $5 for that call option. Now, let's say the stock at the time when you bought it was trading at $100, and after you bought that call option, the stock went from $100 to $101 and went up by $1, or a 1% gain in the underlying stock. What that means is that you can roughly translate that $1 gain in the underlying stock into a 50-cent gain for your option. So your option would go from $5 to $5.50. What that means is that on the stock, when the stock moved up 1%, guess what? Your options trade gained 10%. That's the leverage that you're getting from your options trade. So whenever we talk about options providing you leverage, this is what we're referring to. A 1% gain in the underlying stock gave you a 10% return in the underlying option. And delta gives us an approximation as to how much money we're actually making on that trade. Does that make sense, everyone? Please type 8 into the chat window if that makes sense to you. Now, this is assuming that the stock makes an instantaneous move, but stocks don't move 1% instantaneously. It takes some time. Let's say, and the thing about trading options, the other thing that we have to really understand is that there's time decay. So it's important that we understand how time decay affects the value of our option. So I have the same example. I have stock XYZ. I think the stock's going to go higher. So let's say I bought a call option, and let's say this call option cost $5. And in a week's time, the stock goes from 100 to 101. But before, I assumed that it went from 100 to 101 basic instantly. But now let's say it takes a week for that to happen. What happens is that there's a Greek called theta. Theta measures the change in the option price with respect to time. So this is something that Ed also talked about, which is time decay. Time decay is something that we have to factor into when we think about our options investments, because guess what? The value of your option decays every single day you hold on to it. As a buyer, this is what's working against you. As a seller, this is what's working in your favor. theta helps us understand how much time decay there actually is. So in the previous example, we said that if the stock goes from 100 to 101, we go from $5 to $5.50, which translates into a 10% gain. But if it took a week for that to get there, and the theta of this option is 0.03, that means this option is losing 3 cents a day. So if we multiply 3 cents a day by the 7 days that it took for the stock to move from 100 to 101, what happens is we've lost 21 cents due to time value. So we gained 50 cents due to delta, and then we lost 21 cents due to theta. And that's how we get the end terminal value of our option at $5.29. So that's how we know if we bought this call option and the stock went up by 1% over a week, we would gain roughly 5.8%. So that's what OptionsPlay is actually calculating for you in the background when you use this tool that calculates how much do you make if the stock makes a big move, and you can also specify when you think that stock's going to make that big move by. So with that, that covers what I wanted to share with you here today. I know I went through this fairly quickly, but I did want to make sure that I got through everything, and I do want to open this up for Q&A. But before I do, if you have not registered for OptionsPlay yet, this is completely free of charge to you, courtesy of the Montreal Exchange. I'm going to post this link into the chat window, so for those of you that do not have access to this platform, there's a wealth of information. There's education, there's weekly cover call and short put reports, there's liquidity and earnings reports included in the platform, as well as monthly education that we run to help you better understand these strategies in the same format that I show you here today. So with that, let's turn to the Q&A session. If anyone has any questions, please type them into the Q&A section of there's a chat window and there's a Q&A section. Please type them into the Q&A section, and I will try to answer as many questions as I have time for. Anything that I'm not able to answer on air, I will answer by text after I finish off here today. What options are good to protect from American election volatility? Pat, that depends on your views. So like I said, I'm not here to tell you what to trade. I'm here to explain the strategies to you so that you can understand which is best suited for you. It depends on where you think the markets are going to be. If you think the markets are going to be significantly lower, buy a put option. If you think the markets are going to move a little bit lower and come back, and like we saw in 2016, you might want to sell a put or sell a call, depending on if you have a directional view. Before doing this trade, do we look seriously in open interest and volume? So we generally don't use open interest and volume very much. We always use the bid-ask spread. So we actually have a liquidity metric here on the OptionsPlay tool. As you can see here at the bottom, there's a link for liquidity. When you click on that liquidity link, what we're doing is we're ranking all Canadian options based on liquidity. So open interest and volume, not a great indicator of liquidity. Bid-ask spreads are much better. If the stock increases to 103, the $100 call option you bought would also have gone up by roughly $4. If you sell the call of that option, can you still profit? Yes, great question here. So the question is that if the stock goes from 100 to 104 instead, if the stock goes from 100 to, let's say, 104, and the option goes from $5 to, let's say, $7, can you sell the option for $7? Yes, and what happens is you would make a $2 profit on that trade. So your $5 investment gained you a $2 profit, which is a 40% gain. So yes, you can sell it at any time for a profit. Can't you settle the call option at a higher value than it was bought for, even though break-even prices have not been achieved? Yeah, you can close out any option position. Doesn't matter whether you're buying and selling. You can close an option position at any time prior to expiration. I have bought a call option and still made money, even though the stock price did not go up to the break-even price. That's correct. So you don't have to actually exceed the break-even price. You have to exceed the break-even price at expiration. But that's why the Greeks are important, because if the stock can make a big move in a short amount of time, it doesn't have to exceed that break-even price, and you can still be profitable, especially if the stock makes a big move in a short amount of time. Should we have actual stock in hand for buying put options? You do not need to have any stock on hand in order to buy a put option. How come selling a put has unlimited losses? You can't lose more than $100 per stock. That's correct. So when we say unlimited, there isn't a technical limit because the stock cannot go below zero. So when we sell a put option for $4, the most we can actually lose is only $96 because the stock can't go below zero. If your broker doesn't allow you to do a naked put selling, do you cover it by using buy put for above a $96 strike or below $94 strike? So if you can't do naked put selling, then what you can do is you can buy a lower put here. Let's say you buy, let's say, a $90 put. And what this does is it has limited risk and you're no longer naked. So that's a more advanced strategy, but really, in order to trade that advanced strategy, you must first understand selling a put and buying a put. And what you're doing is you're just combining them together into one strategy. But that's why we do this session, so that you understand the fundamental building blocks so that you can then advance onto these more complex strategies like spreads. Marnie is saying, what would you consider the most neutral or safest, if you will, option strategy? The safest option strategy is going to be a covered call, because a covered call does not increase risk to your portfolio. It's actually reducing risk. It's reducing risk of the stock position that you own. If you're completely risk adverse and you're not willing to take on any risk, then selling cover calls is the best way to utilize options. And then you can start with cover calls, get comfortable with it, and see if you want to take on more risk by buying calls or trading more complex strategies. Where does OptionsPlay pull its bid-ask prices from? We pull it from the Montreal Exchange. All bid-ask quotes in the markets come from the exchange, so we are pulling it from the exchange. So everyone has the same bid-ask prices. I would like to know more. Sorry, I just lost that. Whoops. Oh, I would like to know more on the assumption of the pricing model for the P&L calculator. Does it account for the Greeks? Yes, all of the P&L calculators is looking at the Greeks to calculate that. Can you close the put options before expiration date like you can for call options? Yes, calls, puts, buying and selling doesn't matter. You can always close your options position prior to expiration at any time. To minimize risk, can you exercise to come out of the buy put deal when it starts plummeting more than your max loss? Again, you don't have to exercise. You just simply close out the position. So if you've exceeded your risk tolerance and you want to get out, you can always get out of any trade at any time. You just have to either buy it back or sell it, depending on whether you've bought or sold it to begin with. Can I link OptionsPlay with my Questrade account? That is not something we offer right now. You can analyze a trade in OptionsPlay. Click on the trade button and we'll show you how to enter the trade into your broker's platform. Can we close a sell to open naked call? Yes, you can close anything. So if you sold to open, you would have to buy to close that position. Does OptionsPlay use gamma in its calculation? Yes. So all the Greeks are put into the P&L simulator to give you a rough approximation as to what the option will be worth. Do you know what theta? How do you know what theta is in the number? So we have a tool here in OptionsPlay. Your broker probably will have it as well. But when you click on it, let's say I'm buying this October put. When I click on the blue button, there's here at the bottom, explain strategy in Greeks. When you click on that, it'll show you the theta here. So the theta here, I'm losing $1.57 out of the $93 that I paid for this put option per day. Can you explain more on theta? Theta is just the fact that you have time decay. So this is something that Ed did spend a bit of time on as far as time decay. It's the value of your option is going to decay as you get closer to expiration. And the theta is measuring the speed at which that's decaying. Can we close a sell? I think I've answered that question already. Does your platform only provide Canadian market options? So the free version, courtesy of the Montreal Exchange, is only for Canadian options. You can go to OptionsPlay.com and sign up for a free trial for US-based OptionsPlay, but it is not free, but you can sign up for a free 30-day trial at OptionsPlay.com. How much is a contract? So a contract, we have the trade cost here. So you always know the trade cost here. So we always explain to you here, I'm paying $93. Here I'm collecting $108. When selling put options, would you collect premium if you close the trade before expiration? So if you sold it for $1.08, you have to determine how much it costs you to buy it back prior to expiration, and you take the difference between the two to calculate your P&L. Okay, so with that, that's my time. Again, thank you so much for taking your time this afternoon to listen to all of us, to hopefully help you better understand these option strategies. You know, options trading, learning how to trade options, it's like drinking from a fire hose. There's a lot of information coming to you, but that's why we record these so that you can take them at your own pace along with these slides. Thank you so much, and I hope you guys have a great trading day.